Welcome to Impact Farming, where we introduce you to the people and ideas that will have a massive impact on your farming operation. Brought to you by Farm Marketer. Sit down, start the engine, and let's roll with today's show.
Hello everybody and welcome to the Impact Farming Show. Today we have a special guest with us, Terry Betker from Backswath Management. And Terry is joining us today to talk about the top 3 financial mistakes that farmers make. Welcome, Terry.
Yeah, happy to be here. I've been looking forward to this, and since you presented that topic, I've thought quite a bit about it, and we'll see how the discussion goes. It made me think back. I've done this being talked to farmers about financial management for a long time, and every once in a while I'll get asked a question and it causes me to think, I need to think about that a little bit. So nice. Yeah, looking forward to this.
Right on, so am I. I've been looking forward to it for a long time. So let's dive in, but before we do, can you tell our audience a little bit about you and your company?
Sure. Yeah, my background is agriculture. I farmed for a while. My brother still farms. And then I had this idea to become a farm management consultant, and I've been doing that for a long time. And right now in our company in Backswath, we help farmers with different aspects of their business management, Tracy, things other than operations, production, or marketing. It's in finance and human resource management, business planning, financing, obviously, succession planning. We do record keeping for farms, and we have a software program that analyzes financial performance. We teach finance. So those are the areas in which we spend most of our time. There's 13 of us in the group, and we work with farmers literally all over Canada, but mostly in Western Canada, Tracy.
Okay, excellent. So you have been working with farmers for a long time, and many farmers. So you are a fantastic person to ask this question, and I've been waiting to pick the knowledge out of your mind. On our show here, one of my main goals is to bring farmers the people and ideas that are going to impact their farming operation. Personally and professionally, though, I have a large focus on farm finances and the business end of farming. So when we first started talking and I knew of your background, I just immediately knew you were going to be a great guest for the show because of your experience working with farmers. So you work with farmers across Canada. Now, I am curious. The top 3 mistakes, in your opinion. Yeah. Let's start at the bottom and then work to number 1. Okay. So what would be number 3 mistake that you see farmers making? Sure,
and before we go there, I'd like to make one clarifying point here. Yep. I'm not an accountant. Okay. I have some training in financial analysis, and I really, really enjoy trying to understand how financial management can get applied to farms and their businesses. I find that really interesting. And so I just wanted to make that clear because I think that I try to understand financial management from a little different perspective than an accountant or than a lender. Okay. And some of my comments are going to, I think, come from that place. Okay. So,
disclaimers are good.
The disclaimers are good.
I make all kinds of disclaimers as appropriate, so I like it.
Yeah, sometimes I get asked, and sometimes I get asked a little bit about or comments made about the accounting part of it. And so financial management is such a broad area of discussion, Tracy. So to zero in on certain aspects of it is important. But there's multiple people that participate in that financial discussion with farms.
Absolutely.
And so our focus, my interest is a little bit different than what a lender or an accountant. Okay. Not right or wrong, just a little bit different. My comments are coming from that position. Okay. Excellent. So number 3, we're almost like drum roll here.
We need special effects
up to the top. I think I think the third biggest financial challenge that farmers work with is they try to pay their debt off too fast. And so cash flow, and it becomes an interesting discussion here. So where does cash come from? Cash comes from profit, right?
Yeah.
Or the only sustainable place that cash comes from is profit. But they pay the debt off too fast, and I think a lot of farmers have a goal to be out of debt. And
really?
There's nothing wrong. Yeah, really.
I didn't get that memo.
Yeah.
Sorry to interrupt.
No, but it's okay. And there's nothing wrong with anybody having goals such as we would rather have no debt.
Right.
But it's almost impossible to expand or reinvest in the business without expansion, without incurring debt. So the issue becomes is how do we manage that debt? And how do farmers manage the risk associated with that debt? And a lot of them then, I think, back to my point, simply are trying to pay the debt off too fast. And in all of this stuff, I think if we can take that discussion in any farm or any group of farms and quantify it, then it helps to place context in a discussion with a farmer around why do you have your debt structure the way it is? Why are you trying to pay all that debt off so fast? So we have a ratio. And a lot of I think the understanding, the insight into a farm's financial performance can be quantified in a ratio. Now, important to this, Tracy, is that all this analysis, all the discussion, distilling financial performance down to a ratio, really needs to be underpinned by the fact that farmers can't manage what they can't measure. So they need the ratio. But then at the end of the day, the numbers, the ratios don't make the decision. They provide context to the discussion. Okay, so having said that, if we want to come back to my comment about farmers trying to pay the debt off too fast, it is the structure of the debt. And so, without trying to get too technical here, we want to take in any farm the total debt and then understand how much of that debt has to get repaid in the next 12 months. That's called the current debt. And so farmers, a lot of them will have long-term loans with credit unions, banks, FCC, provincial lenders, and of course only a portion of that long-term debt is going to get repaid next year. But then there's other debt. And the other debt are the operating loans, the accounts payable, the credit cards, the advances, commodity advances. And technically, those are all part of the overall debt that's trying to get paid. So the principle here is to match, as best a farmers can, the ability of their business to generate cash flow from operations, from what it is they do, farm, and align that with those repayment requirements. And to my point, mistake is a pretty strong word, mistake, but challenge number 3, or things that we could do better, maybe, number 3 is make sure that the farmer tries to align the ability of the farm to generate the cash with their debt structure. Now, where that works, the cash flow is really good. But it's on a farm, there's some things in the financial part of their business that can change really quickly. And one is their cash flow, the liquidity. I mean, it's called liquidity. So the cash flow. And where farmers then try to pay that debt off too fast. So it's not uncommon for me to run into a farm where, by analysis, by the ratio, that they will be trying to pay their debt off in 3 to 5 years. 30 to 50% of all their debt technically due in the next 12 months. So for some of them, they can manage that. And I got another comment here. There's no problem in having really aggressive repayment schedules. There's no problem, in my opinion, in having a farm with really aggressive debt repayment obligations. It only becomes an issue when that obligation starts to negatively impact on the management decisions that they make on the farm. Having to sell when they don't want to.
Oh, yes.
Can't buy when they would like to. Can't apply or make an investment in inputs or capital when they would like to. Okay. When it's really in the best interest of the business, because they've got their debt structure out of whack on the balance sheet.
Yep.
So, challenge number 3, mistake number 3. If I'm going to, and I actually, when I got your email with the outline here, and I thought about this, but this isn't something that I'm speaking here for the first time. When I make presentations on finance, if I do a workshop, I will actually tell the participants that if I was going to think about 2 or 3 things that I observe farmers struggling with financially, the number 3 one, the first one we're talking about here, is debt structure.
Okay.
Trying to pay the debt off too fast.
Okay.
Can I say one more thing?
Absolutely. The floor is yours.
I think some of this comes from the notion that we're paying interest. And so the faster we pay the debt off, the less interest we're going to pay. And I mean, that's obviously true. But there's a principle to leveraging the business. If you can take somebody's money at 3 or 4% or whatever that is, and use it to your advantage, it's just like putting fertilizer. You're buying fertilizer, using it to give you an advantage. We just have to take the money, the investment, and the cost of that is the interest. Make sure we manage it correctly. And then there's another thing that I think maybe not so much of a current issue, but I know from past, and farmers that have a little more gray hair, was that they couldn't structure their loans the way they can now. Every lending institution now will allow a farmer to structure loans, and if they have some really good times, they can pay it off faster without any prepayment penalty. It's that's a little different now. So there's no reason, in my mind anyway, for a farmer not to structure their debt and just make it so that it matches up with their cash flow. And if they do have some good times, they can go down and pay these loans off faster if they so choose.
There you go. Give yourself the flexibility, but don't put yourself in a bad position. Can I ask you a question?
Sure.
I want to know if this is correct. Is money easier to come by in 2019 than it was 50 years ago, 60 years ago?
Oh yeah, that far ago. Yeah, we agriculture farmers have gone through cycles where they've had not enough access to capital, and then too much access to capital, and then it got restricted again.
Okay.
Right now, that's not a problem.
Okay.
Yeah.
And I know, and I wonder too, you would know this, and we can probably talk about it all day long, but is that maybe an age thing, a mindset thing, a personality thing? Because I know the generation with more wisdom, is that how we word it, are a little more hesitant to borrow and have that outstanding debt, where younger are a little more free-flowing with debt? Is that
sure? I think that
safe?
I think that's safe. I think that's just. That's just we're all humans, and typically as we get a little older, our risk tolerance changes, right? So I think what you said is absolutely fact. Some of the younger farmers, though, and this I don't know, and it concerns me a little bit, but you could have somebody who now, Tracy, has farmed for 10 years and never experienced tough times.
Oh,
and
sure.
And what you're talking, and then if we're leveraged up and maybe it never cycled back to where it was in the 80s and into the 90s.
We hope not, but
even in the early 2000s, for some farms, it was getting a little bit dicey. So I think what you've said is absolutely just a fact of life.
Anyway, sorry, I went a little left field with that, but you think of different people generations, personality types, and exactly like you said, where they try and pay off their debt too quickly, and personally thinking of some people, then it shoots them in the foot and they make poor decisions short term, right?
Yeah.
So a note on that.
Yeah, no, fair ball. Okay.
Now let's go to number 2, drum roll.
Yeah, well, I think the second biggest mistake farmers make is it's what they don't know.
Okay.
And it's what they don't know about how financially efficient their business is, or isn't, or should, or needs to be.
Okay.
So when I talk about financial efficiency, I'm talking about the part of their business that applies to their income statement. Sales or revenue minus all the expenses resulting in net income. And farmers make an investment in all the expenses that they incur to operate a farm. And I think it's important and provides, I think, actually incredibly valuable information to a farm to understand what kind of a return they're getting on each of the different groupings. You can group the expenses in different categories. The return on the investment they're making in those grouping of expenses, And so, not to get into the detail of what those groupings are, but I think typically we would look at production costs. So that would be investment in fertilizer, chemical, seed, feed, vet, supplies, things like that are a grouping of investment that farmers make in the business that they're in. And then we create a margin, and we look at the return that they get on that investment. And then the next grouping would be other variable costs, things like fuel, repairs and maintenance, custom work, and what kind of a margin they have and what kind of a return they get on the investment in those expenses. And then we go down into what farmers would more typically be associated with is the fixed cost or the administrative costs, like property taxes, professional fees, consultant fees.
Gotta have those.
Gotta have consultant fees, yeah. And then always calculating a margin. Okay, so now if a farm is looking at how they can make more money, increase their bottom line profit, then they can do that by producing more, obviously.
Yeah.
Selling it at a higher price, or cost control. So trying to figure out, am I getting a good return on the investment that I'm making in any of those expense categories? And so the question I have for farms I get from farmers often, and I think this has got to be a pretty uncomfortable place to be, but where they're not happy with the financial performance of their business, and they'll say to me, we just don't know where to begin to look. Because no slight to a lot of accounting firms or lenders, but they don't present the financial information to farms in a way that farmers can look at enough detail to know, well, these costs or this group of costs is causing me problems on the farm. And what can I do differently in that? Which then leads me to the next part of the challenge. First, they don't have the information. They don't know how financially efficient they are or aren't. That is not difficult to do. We're not talking about filing tax returns here. I mean, this is basically taking your expenses and your income, organizing them, and calculate some ratios. It is giving the farmer insight into where their business is efficient or not, or where they could begin to look differently. So notwithstanding more yield or selling at a higher price, then we got to try to manage those costs. So that becomes cost control. So I ask farms, I say, well, what's your philosophy around cost control? This is an interesting question. Is it, I mean, I'm going to generalize.
This is a good one.
Yeah, I'm going to generalize here, but are farms, or if I talk to any farm that's listening to this, is your philosophy that if we need it, we buy it? And most farmers would say, yes. And I wonder if that's a little bit a function of the good times lately, because if we need it, we buy it.
True.
But what of those costs do we have some discretion? Are there options about the timing or the investment or how we would do that? And so now we don't have enough time to drill down into that, but I think then in costs, then it becomes a function of that philosophy. And Tracy, it's interesting because when I have a discussion with farms about that, they just intuitively make sense to them. Never thought about that before. Maybe we need to have a little different focus on how we get at and understand the investment we're making in all of these expenses. So that leads me then to the next part of this discussion. I think, well, I observe that in cost control, if I compare a bunch of farmers, and actually we do benchmark, look at performance, it's really interesting because we'll see the variance between farms that are more financially efficient than those who are less financially efficient at the operational cost, like at the production cost level, up at the gross margin we call it, being narrower, less variability between really efficient farms and farms that aren't as efficient. But the interesting thing is we drill that discussion through the whole income statement and we get right down to the fixed costs, then the gap widens. And my observation is that it just makes sense because farmers are they farm because they want to do the work. So their focus on gross margin efficiency is just higher because it more closely relates to growing the crop, raising the beef, or milking the cows.
That makes sense.
It makes sense.
Yep.
And then less focus on all the other costs. So we watch the better managed farms do a better job of overall costs than the others.
Okay.
And my last comment here on this then is, okay, what next, or what about that, and how do we get at it? Well, I think budgeting helps.
Excellent.
And a lot of farmers will challenge, well, how am I supposed to budget because I don't know what's going to happen? That's exactly the point. We don't know what's going to happen. But I observe farmers who start to become more purposed in budgeting, and they get better at it over time. Because on any farm, there is patterns of cash flow.
Totally.
And so we can budget and benefit and learn and know that if we've budgeted this for repairs and by the middle of June we're already there, what do we do differently? Can we, from the rest of the year, be a little bit more careful about those? And there's no home runs, Tracy. You know, in this one, at least I don't believe there's home runs. Maybe 2% of the farms could pick out something and say, holy, this would just be a magic fix to my profitability. This is attention to detail. This is really drilled down into managing what we have. And and so budgeting and financial efficiency, I think, can help a farmer to achieve better bottom line profit. So that's number 2.
I like it, and I'm smirking. I'm a big believer that personally, everybody needs a budget because you need to know what your income is and your expenses as a person and a farm. I mean, you can't. Yes, there's variables. Of course there is in your income, in your expenses. But you know what? The bulk of it is the same. And you know, I was smirking when you were saying that because I'm thinking of a line item on our income and expense statement. And every year I go, what?
Yeah.
Well, I go, Anthony.
But that's the point, and that's
the point.
That's something else I find really interesting because often when I'll have the farm's financial statements that they got from the lender or from their accountant, and we'll start to dive into it, and they'll be, well, I don't know what that cost is. Well, we then that doesn't mean it's bad. We just got to go back and understand, and then what could we do differently about it? And maybe there is, maybe there isn't, but that's the whole purpose.
That line item too. When I looked, I'm not going to say what it was, but you look. Well, it was repairs. I mean, that's not confidential, but you look at repairs, and it's funny. You know, your machinery breaks down, your vehicles break down, and it's $2,000 here, $5,000 here. You know there's a cost, but then when you get to the end of the year and you see. Now, where the management decision comes in, we look at that and we go, well, the tractor costs this much to fix. The payment is X. Is this the point where it makes sense to buy something newer, where all of a sudden that in all hopes, the newer tractor will not be costing this much in repairs, in all hopes, right? So anyways, I was smirking because every year we seem to have that line item that we look at, but if you don't measure it and pay attention, you know what, those little 5,000 here and there just sneak up on you, and you don't know.
And you don't know. I don't know if we're going to have time to get to number 3, or the top one. Maybe everybody will say, oh, no, rats.
No, we're good.
We're good? Well, because I want to drill down into that discussion. So let's pick on repairs and maintenance.
Okay.
So the one thing we haven't talked about here is the importance of having at least a 5-year trend line. Because over 5 years, let's just pick a repairs and maintenance, they're going up on a farm. And your point, at what point in time do you say, that's too much and now we got to buy a new air seeder or whatever it is? And so it comes to mind, I have had discussions with farms where they thought that they were doing the best by fixing.
Right.
But there's something that where your head would, the cost of buying a new air seeder is interest and amortization, but there are hidden costs to not doing it. Not just the repairs that are going up, but at some point spending more time fixing than you're in the field, and then your yield goes down. And so you can then or incurring too much in custom work costs because you can't get the work done.
Then it's part of a big picture then.
Exactly.
You can look at it and make decisions.
You drill down into the financial efficiency in the detail and understand that, but then go back to what are the other performance indicators that we're looking at here, and at some point then actually fixing that piece of equipment, which might be saving me the capital cost of replacing it, is actually costing me money in another area. And back to my comment that if farmers don't have the information, how do they make those management decisions?
No. And like I just said too, I mean, we have it right there, and we've been doing our financials since we started farming, maybe the second year, but every year you go, okay, now our repairs, and I mean, we track month to month, but when you see your full year at a glance, you go, okay, so this is not the first year that we're here. This is year number 2. What do we want to do, right?
What do we want to do?
Okay. That's number 2. Do we need a drum roll?
I don't know. We'll see.
Okay, number 1.
Number 1, I don't think farmers use the information they have to its best advantage.
Okay.
And that's a bit broad, but I don't experience this a ton anymore. It used to be more frequent, but I did experience this just within the first week of January as I went to visit a farm, and they've got some financial challenges, and okay, well, can I see your financial statements? And I went to the farmer went to the filing cabinet and gave me the envelope from the accountant, and it wasn't open. And so I think that there's information that farmers have, and I think a lot of it is what we've been talking about here is who do they talk to? Who can they go and have a discussion with about their financial performance, and of course their lender and their accountant. And a lot of farmers will be getting really good information from those two sources. But I still find generally that there's something missing in that discussion, and I kind of wonder if it's not enough application to where and what is it that we're doing on the business. How do farmers take the information that they have financially, so in their internal records and in those financial statements, and use it, understand it, and then apply that information to management decisions, investment decisions going forward.
Absolutely.
And so what are we trying to work to achieve here? I think that the financial information has to be presented or understood in a way that the farmer can confidently take that information and use it to support the management decisions they make. And remember back to what I said right at the start, the financial information doesn't make those decisions, but it provides good context to it. I think it's got to be uncomfortable for farmers to make decisions about buying land or re-upping the machinery on I hope it works. I think it's going to work.
That is uncomfortable.
We should the decisions should be grounded in as much financial detail that the farmer wants to support them in those decisions. So I think that, the biggest challenge that farmers, or biggest mistake farmers make, is not using the information they have available to them, the financial information they have available to them, to its fullest advantage.
Yeah.
And so we take the financial statements from the accountant, and we understand those. We set goals, financial targets. This is really interesting, because I'll ask farmers regularly if they have any financial targets. And in all the years I've done this, I have only had one farm, true story here, only one farm that said that they had an actual written down financial goal. Now there may be lots out there, Tracy, I just haven't ran into them.
Right.
And that farmer knew exactly how much equity he wanted in his business 5 years from now. Now, when I ask farmers that, I have also yet to have I haven't had a lot of farmers say they have them. I haven't had a farm family yet say that doesn't make sense to have some kind of a financial target in mind. How much cash, how much working capital do you want or need to have 5 years from now? How much equity? How much debt do you want to carry?
Yeah.
What kind of profitability targets do you want to set? And then we try, with the information that we have, to make the decisions that will give us the best chance of working to those future targets. It helps in the discussion to take the information from their records that go to the accountant, that end up in financial statements, that get used by the lenders to support management decisions or investment decisions, and then bring it back to the farm so they can use it and discuss it amongst themselves, context to the decisions going forward. If we make that decision, it's going to have that, hopefully have that positive, or sometimes it's not a positive. Sometimes a decision that they're going to make is going to actually result in more debt, so more risk associated with debt, but purpose towards where they're trying to take the business. So they take that historical information, make those decisions, and understand the impact of those decisions on those targets that they've set for, I don't know, there's any number of ratios I like to track, about 5 or 6.
Okay.
That's really important things to track towards. Yeah, so I kind of rambled there a little bit, but back to my point. The number one thing that I think farmers could do a much better job of when it comes to financial management is to use the information they have to its fullest advantage.
Yeah, I agree too, and I like to think of my life and the farm, and same thing. We could easily get our financial statements and never look at it, but at the end of every year, I pull it, and then we look at comparatives from years gone by, and then we use that to decide and go, okay, we're way out here, and here is you know what? I think what I've found is people rely on the banker, the accountant to be the controller. And they don't own that, where farmers should be doing their budget, their income, their expenses, and looking at that, because every person, correct me if I'm wrong, but the accountant and the banker, they're all parts of the puzzle. And we can't just say, okay, the banker said this, so we're good, without looking at those whole numbers. Is that kind of what you're saying?
Yeah, that's what I'm saying. And those relationships have changed in the past. Like where can farmers turn to get some of this access to some of this information? And that's a tricky question. Because if we go back a few years, some of the departments of agriculture in different provinces had resources that farmers could go and talk to, but because of budget constraints, those aren't as readily available as they once were. Lenders their businesses have changed, so the relationships aren't what they were before. It was pretty common in years past for, any lender to have someone that would have been in a branch for years, maybe a career.
Yes, right.
But now that's changed, right?
Yeah.
And then accountants, they are time constrained at certain parts of the year, and unfortunately they're time constrained at a time of year when farmers are wanting some of this information, right?
Oh, yeah.
So it becomes problematic, which leads me to another point, that oftentimes a farmer, I think, doesn't take the best advantage they can from their financial statements because they don't get them back from the accountant very quickly.
True enough.
True enough. And that's not necessarily right or wrong. It's got a lot to do with the relationships that the farmers have with their accountant. But my point I'm trying to make here is that most farmers, as soon as we're in January of this year, and for probably a couple of months already, we've been looking to next year. So farmers, their just orientation has to be to next year, has to be ahead. And that's all I'm trying to say here, is that we need to take that historical information that's there and readily available to them and apply it to where their heads are. Yeah. What am I going to do? What's happening? How do I do this? How do I do that? Yeah. That's the bridge.
Okay. Yeah. I love it. That's some good stuff.
Well,
Go ahead.
No, it's good stuff. I find that
good stuff.
Yeah, good stuff.
Tough topics and areas for improvement, but that is some good knowledge, and you're the perfect person to ask because you see the producers that are probably knocking it out of the park, and you see the ones that call you in, right?
Yeah. So I'm just itchy to make a comment.
Please. Please.
I've watched farms that by applying more focus to financial management, farms can create better financial outcomes.
Absolutely.
I've watched it happen so many times. So I think there are farmers that well, how do I even begin to do this? It's kind of like that proverb. What's the proverb about when's the best time to plant an oak tree? Like 30 years ago or today? Yeah. Back to what we started way early on here, that we had a lot of, it's a broad area, and I don't think farmers should be second guess where they're at. They have to make a commitment that we're going to get perhaps a little bit more proactive in terms of financial management, and then take the first step.
Yeah, and just jump in.
And just jump in and start. And not everybody knows everything about it, and start. Yeah.
But you know what? Farmers are brilliant business people. Yeah. They're brilliant at production. They're great at business. And you know what? For everything they do in their day-to-day life, to sit there and take the income and expense, and I know many people are on top of this, but to sit there and then dissect it doesn't take a long time.
No.
It really doesn't.
No.
And then every year you just add it, and it goes into that data, and then you go, oh, okay, we're on track.
Yeah.
Or, hey, maybe let's cut this cost. Or, oh my goodness, we just did this. We really need to add more cows to the herd to cover this cost, right?
Yeah. No, everything you said, is 100% correct.
Okay. I love it. And I hope we're going to be diving into a bit more financial stuff with you in the future, but this gives us a great starting point. And I know farmers are savvy and they want to know the best business management practices, so this is great.
Yeah, well, whenever the next one is, I'm happy to come and talk to you about it.
Good.
Yeah, there's a little bit more financial stress in certain parts of Western Canada anyway than there were in the past 2 or 3 years. So it's timely, I think, to try to talk about this.
Okay. And I'm going to ask you one thing here too, and it's, you're here representing Back Swath Management, but speak as a consultant. I want you to talk to farmers. What does a consultant do? Because as much as we think that is a standard practice, I'm sure there's a lot of farmers going, oh my goodness, it would be amazing to have somebody help me with this.
Yeah.
So can you talk a little bit about what consultants do? And we're not speaking to your company, but just share what a farm consultant does. Yeah,
when it comes to financial management, and I think that what a farmer should look for from a consultant or an advisor, other than their lender, than their accountant. Tracy, they can get the type of stuff we're talking about, they can absolutely get from a lender or an accountant.
Okay.
And I guess my comment to farmers, but if you have that relationship with your accountant, then just hang on to that person forever.
Excellent.
Because they're valuable. But we're talking about that large number of farmers that don't maybe feel they have that resource to. And so to your point, if what the consultant should be able to provide the farm with when it comes to financial management is first and foremost, number one, understanding.
Okay.
So I should, or anybody like me, and there's quite a few people out there, should be able to go to your farm, take your financial information, and speak to you about what it means, and talk to you in a way that you can understand. Not all the technicality.
Right.
I don't think you need at the start to know how to calculate that ratio, but somebody should be able to explain to you what's happening in your business financially, where your financial strengths are and where your financial weaknesses are. That's what I think a farm should reasonably expect to get from a consultant. The consultant should not tell the farm what there should. I have a strong opinion on this. We as consultants should not tell a farmer what they should or shouldn't do. We need to present information to the farmer that supports the decisions that they're going to make.
Nice.
Yeah.
Great. And I think it's becoming more and more common in farm families to reach out, because consultants are one more professional on your team, just like your lawyer, your accountant. If you can have a consultant, then you have all those experts, because as a farmer, I mean, the production is a full-time job. So to expect yourself, I mean, we need to know how to dive in and read those financial statements and be on top of that. But we can pull from the expertise of everybody's brain, and a consultant's just the same, right?
Yeah, absolutely. And I don't think it needs to cost tens of thousands of dollars. It absolutely depends a little bit on how complex the farm is and how big the farm is, and sometimes there's multiple entities and statements, and we've got that's the other thing. I'll often run into a farm that's got 3 or 4 corporations or operating together, and there's nobody's ever put them all together so they know what the collective financial capacity of the business is. Yep. That's kind of a whole, and they're all, those different corps are all there to manage the tax, which is good, but we got to bring it all together and know, okay, what's going on here financially on this business?
Yeah, that'd be a little tricky.
Yeah, so it doesn't have to cost a lot of money, but I guess maybe I'm a little bit biased on that.
Well, and I enjoy it. I'm speechless for the first time ever. No, that's great that you say that, and I wanted your opinion on that, and we're here getting you to share your expertise, so I appreciate you sharing that, because for many, a farm consultant is something they know about, heard about, use. For others, they're going, I didn't even know that was an option. Wouldn't that be amazing to have somebody come in and help guide us with our decisions? So,
it underpins stress. I'm sure that there are discussions in farm families about finance, and it comes largely about they just don't know where things are at. It's just got to be not a comfortable feeling, and a consultant's not going to save the day, but back to your point, the consultant should be able to, with clarity, tell you, for example, what your financial strengths and weaknesses are, and then where to begin to look to make some changes.
Okay, so that was good. We counted down 3, 2, 1.
Yes.
And you shared some amazing information, and I want to thank you for doing that.
Yeah.
I really look forward to chatting with you further and doing more in-depth episodes about some financial information. In the meantime, if this excited somebody at home and they want to reach out to you or any other consultant, most importantly, if they have questions for you, how can they find you?
Well, they can go to our website, I guess, Tracy, and call me. That would be the email me. Okay. That's one avenue. we can do things at a distance with farms. Anybody can, because of the technology and the ability to look at computer screens from here to there. I know that there's a family that I'm talking to right now, and they're in Grand Prairie, and my office is just outside of Winnipeg, and we don't meet in person. So other consultants will have that same ability. So it doesn't take a lot of in-person discussion sometimes. So I'll be happy to reach out if there's things. So farmers will ask me, could you share this information? We'll send them information. If somebody wants to know what the 5 most important ratios are that I think, I'll happily send those to them with the formulas and how they're calculated and what they mean. We'll help in any way we can.
I love that you're so passionate about helping farmers. That's our mission here on this show too. So I appreciate that. Thank you so much for coming on, and I look forward to the next time.
Yeah, me too. Thanks, Tracy.
Thank you.
Right.
You've been listening to Impact Farming. For more great episodes and articles designed to help you manage and grow your farming operation, head on over to farmmarketer.com. Don't forget to sign up while you're there. We will see you on the next episode.